In this video, I'm going to explain the difference between a tax deduction and a tax credit. So conceptually, tax deductions are going to reduce taxable income, and credits are going to reduce the actual tax dollars that are due, that are owed to the government, right? So that might seem like a very subtle difference, or it might be a little too abstract for you. So let's just jump into an example, and it'll make it a little bit easier for you to understand. So let's say in our example that you have taxable income for a year of $14,000, all right? And your tax rate is just 10%, right? We're not going to get into progressive tax rates here to make it simple. And so we just say, well, how much tax is due? How much is owed by you to the government? Well, we just take the $14,000 and multiply it by 10%, and that gives us $1,400 tax due. Now, I want to introduce a $500 deduction, right? So let's just put here, let's say that you have a $500 deduction, and let's see how that changes things, okay? So $500 deduction. Now remember, we said that if deductions reduce taxable income, right? So because we've got a $500 deduction now, we're going to take $14,000 and subtract 500, right? Subtract the deduction, and that's going to give us $13,500, right? Now the tax rate is the same, right? That hasn't changed, so that's 10%. So now what is our tax due? Well, we just say 13,000 times, or excuse me, 13,500 times 10%. So that's going to give us tax due $1,350. So you see our tax is lower than it was originally because of the deduction, right? Now let's say that we want to talk about a $500 tax credit. And I think this is going to show you, rather than me just telling you, the difference between deductions and credits. So now, let me just change colors here to try orange. So now, credits reduce tax due, right? They don't affect taxable income, right? So taxable income is going to stay the same. It's going to be $14,000, right? The tax rate is going to stay the same of 10%. And so the tax is going to be, initially, before we factor in the credit, we're going to say that we're still at $1,400. But now what happens is, after you get this initial tax due, we should say, now you deduct that credit, right? That credit comes out from the tax due. So we'll say, and I'll just put it in parentheses here so that you know that it's being deducted. 500 means it's being subtracted. That's going to give us an actual tax due of $900. Okay, so let me just really highlight this so you can see the changes in tax due, because this is really what matters, right? Ultimately, what you pay to the government is what you care about the most. In this case, you pay $1,400 to the government. When you have the $500 deduction, you end up paying $50 less to the government. And when you have the $500 credit, you end up paying $500 less to the government, right? So you see, tax credits reduce the tax that you pay dollar for dollar, right? So a $500 credit means you will pay $500 less in tax. Whereas the deduction, right, that reduces your tax due, but not dollar for dollar, because it's reducing the base upon which that rate is calculated, right? It's reducing this taxable income, right? And so what we ultimately have, and I'll calculate out, we'll put the actual savings down here. So let's say the tax savings in each case, and let's see here. So we have $50, and when I'm talking about the tax savings, I'm talking about the actual amount that you pay, right? That's what you care about. $50, right? $1,400 minus $1,350 is $50. And then here we have, you saved $500, and you're just taking $1,400 minus $900, right? So you paid $500 less. So we can look at this and say, okay, when we think about a deduction, okay, this is reducing tax due. I mean, it's reducing our income, but ultimately it reduces tax due by the marginal rate of the tax, or by the marginal rate of taxes that we're paying. In this case, 10% by marginal rate. So another way to think about it is we say, okay, well, it's a $500 deduction, right? But times the marginal tax rate we were paying of 10%, right? So it's really saving us $50, which is what we have right here, okay? But then this credit reduces tax due dollar for dollar. This is crucial. So in that sense, you might say it's better if all else equal, if you get a choice and you say, well, look, you can have a $5 tax credit or $500 deduction, generally the credit's going to actually reduce your tax due by a larger amount.